Hello everyone, it's Dale here. In this video I'm going to talk about rejections. I'm going to tell you how to tell the difference between a good trading opportunity and a trap, and I'm going to give you a checklist which will help you to tell the difference between a good looking trade and a bad one. Now, I'll also show you how I trade rejections. I'll show you exactly step by step my strategy so you can apply that to your trading as well. Now, let's kick this off by looking at this chart. And what I have for you is a little question. I want you to look at this chart and I want you to tell me what is the first thing that you notice when you look at this chart. I hope that most of you said that it is this part of the chart, this strong rejection of lower prices. So this is what I call a rejection. It is when the price goes one way very aggressively and then turns and goes the other way also very aggressively. This is a rejection, and this is what this video is going to be all about. And rejections are very special because many traders place their trading decisions around them, and it doesn't really matter what strategy they use, because when something like this happens, everybody who is trading this chart sees that and plans their trading around this, because this is clearly the most important place on that chart, right? So no matter which strategy you trade, when you see this, you simply can't ignore it. That's the beauty of the rejections. Now, many traders use those as support and resistance zones, which is completely fine. The only problem is that they don't always work as strong support and resistance zones. And this is actually what I want to focus on in this video. I want to teach you how to tell whether this rejection will work as a strong support or a resistance zone, or if it's likely a trap that will eventually not work as strong support and a lot of people will burn their money there. So, as I was saying, I have a little checklist, and the goal of this checklist is to tell whether this is a good trading opportunity or no. In other words, is this a good support or resistance zone, or if this is a trap. So let's now take a look at the first point from that checklist. And the first point is you want to look at the market structure. And you want to see that the strong rejection was formed when the market was rotating. In other words, if you look at the volume profile, if you use volume profile, then the volume profile should be D-shaped, like capital letter D. If it's D-shaped, then the market is in a rotation. Obviously, you don't need volume profile. You can just look at the chart like this, and if it's rotating, you can tell just by, naked eye. But the point is, if the market is rotating, then the chance of those strong rejections working as support or resistance zones is way higher. And the reason is that when the market is rotating, the price tends to return to that channel. So let's say that this is the center of that channel. This is the high border. This is the low border of that channel. And the price simply makes those rejections and goes back towards the center of the channel. That's why you want to prioritize those rejections that are inside a channel, or in other words, in a rotation like this. Alright, so the first point from the checklist is that the market should be in a rotation, as the chances of the rejections working as support or resistance zones, in this case this would be a resistance, is simply higher, because the price tends to go back towards the center of that rotation, right? So market structure should be a rotation. And again, if you use volume profile, then it's super simple. It should be shaped as the capital letter D. Okay, so that's the first point. Second point is the strength of the rejection. What I've prepared here are two examples, a good one and a bad one. This is a good rejection. This is a bad rejection. Now, let me show you the difference. A good rejection or a strong rejection looks like this. You can clearly see that point where the price turned. This is the high, this is clear high. where the price turned and suddenly went into the sell-off. It's sharp. If you look at it, the rejection is sharp. It looks like this. Boom, boom. Now, if you look at the second example, at this rejection, then this high of the rejection is weak, right? There's not really a clear point, like in here, where the price turned, because the market tested like 4 times, but never really made a strong high. Like boom, boom. So this is a weak high, and this is a strong high. Now, a good rejection has a strong high, because the good rejection should tell us that there is that aggressivity, right? Aggressivity, in this case, of sellers who jumped in and started to sell aggressively, right? This is aggressive selling. But right here, it looks like the sellers weren't really sure. There wasn't that strength, that aggression, right? So the second point from that checklist is that the rejection needs to be strong. It should look like this, not like this. Okay? We need to see aggression. That's what the rejections are all about, right? So that's the second point. Now, the third point from that checklist is volume distribution. You want to look into that rejection, and ideally with flexible volume profile, which will allow you to look specifically into that rejection zone like I did in here. And you want to look at how the volumes are distributed. And this is quite important because sometimes if the volumes are not well distributed, it could tell you that this is actually not a strong rejection but a trap. So let me show you. This is a good scenario how it should look like, right? So we have a rejection, and within that rejection, you want to see a strong volume cluster, heavy volume zone, easily visible. It should be super clear where the buyers started to jump in and where they placed most of their volumes before pushing the price upwards, right? So you need clear volume cluster like this one. Behind that, there should be low volume zone, like this one. And this is also very important. It's not just about the heavy volume zone, but also about the weak volumes which are behind that. The reason is that the weak volume zone is telling you that nobody was really willing to trade here in this area, right? That's why the price turned and went upwards, right? Nobody was willing to trade here. The buyers were buying here, that's why we see the heavy volumes there, and from there they pushed the price upwards, but nobody was willing to trade here, almost nobody. Now, let's compare with this example. Now, in here, we have this rejection, and if you look at the volume distribution, you can see that the heaviest volumes in that rejection were actually very, very close to the low of the rejection. And this is what I call a trap, because it tells us that when that rejection happened, there were many people willing to trade in here, right? At the bottom of that rejection. We don't want that. We don't want people to be willing to trade in here. The reason is that if you trade those rejections, let's say that the market makes a pullback and you want to use this rejection as a support and go long from there, like this, what's likely to happen is that the market will want to test this heavy volume zone. Market likes to do that. It's always in search for liquidity, right? So it's very likely that the price will do this. Test below this heavy volume zone to see if there's anybody willing to trade there. They do that because in the past there were traders willing to trade here, right? So they go and test that zone to see if anybody is willing to trade here, which is a problem. If you went long from this place, then yeah, this would be a losing trade, right? If the price continued to go downwards against your long. So that's why I call this a trap. And if you see this, then it's definitely not a trade which you want to take, right? So the volumes should always look like this. Close to the rejection point, there needs to be that heavy volume zone, but behind that there still needs to be that low volume zone, marking a place where nobody was really willing to trade, right? If you compare it to the bad volume distribution, then in here the volumes are heaviest very close to the low, which is not good. That's a trap. Okay, so that's the volume distribution. And one last thing here, one last point from that checklist is whether there's a fair value gap in that rejection. Now, fair value gap, that's a concept from smart money trading. Let me explain this really briefly. It's basically formation of 3 candles. Let me draw a bearish fair value gap real quick, all right? So this is our first candle, second candle, third candle. This is a bearish formation. And a bearish fair value gap is, if you look at the low of the first candle, this one, and the high of the third candle, right here, if they don't overlap, then it's called the fair value gap. And it is this whole zone. This is fair value gap. Beginning in here, ending in here, right? This is bearish fair value gap. For bullish, it would be the same, just reversed, right? In this case, we have a bearish rejections, so we are going to focus on the bearish fair value gaps. So if you look here in this example, then you want to look into that rejection and you want to look for the fair value gap there. You want to see a fair value gap there. So low of the first candle, high of the third candle, right? So this being the first one. It doesn't matter if it's bearish or bullish, by the way. So this is the first one, this is the second one, and this is the third one. This is the third one. And this whole area, that's the fair value gap. The reason I'm talking about this is that fair value gap shows aggression, right? In this case, aggression of sellers. And a good rejection should have a fair value gap because, as I was saying, you need to see that aggression, right? And one of the ways how to spot the aggression is through the fair value gap. Now, take a look at this example. Is there a fair value gap within this rejection? And I mean, you should look at the fair value gap in the selling area of that rejection, in this part, right? So, is there a fair value gap in this area of the rejection? There's not a fair value gap, right? So there's not that sign of aggression here, which is not good. We want to see aggression. So if a rejection doesn't include a fair value gap, then it's not ideal rejection, right? So that's the point number 4 for my little checklist, saying that the good rejection should have a fair value gap, like this one. Now here is a little recap of that checklist. Here are all the 4 points. The first point is that market should be rotating, right? First point on the checklist. Second point, rejection needs to be strong. Third point, the volumes need to be distributed well. And the fourth point, there needs to be a fair value gap. If all those points check out, then the rejection is most likely going to work. It's most likely going to be a strong resistance or support zone, right? Now, all those conditions doesn't need to be met, because in trading nothing is ideal, obviously. So at least for me, it's fine if only 3 conditions from this little list are met. If 3 conditions are met, then I still trade the rejection. I still consider it a strong support or resistance zone, right? Obviously, if it's all 4, then even better. But if 3 conditions are met, it is still good to trade, all right? Now let's put this into action and let me show you how I trade this. I'll give you 2 examples of 2 trades. In here I have that checklist for you, so we can check it as we go. So the first thing, the most important thing to do is identify a good rejection using this checklist. So let's check out this one, this rejection right here. Is the market rotating? Yes, it appears to be rotating. Even though I don't have the volume profile printed here, you can see that the market is going up and down, it's rotating, right? So yeah, this checks out. Is the rejection strong? Look at the high. Is it strong or no? There's this clear high, right? High of this candle. So yeah, it is a strong rejection, so that's good as well. Now, let's check out the volumes. Are the volumes distributed well? We have this heavy volume zone right here, very good looking, and above that, low volume zone. All good so far. Market is rotating, rejection is strong, volumes are distributed well. Now, is there a fair value gap? There is, right here. Fair value gap, showing us the aggression of sellers. So all this checks out, right? We have a strong rejection. Now the only thing we need to do is trade this. So how do I trade it? After I spotted a good looking rejection, I want to see a pullback back into the zone where the heavy volumes were formed before. This is a resistance. For me, the resistance is not at the top of the rejection, it is the heavy volume zone. That's the most important zone because the heaviest volumes in that rejection were formed there, right? So that's the resistance I want to trade. This resistance is not just a level, it's always a zone. The beginning is usually at the beginning of that heavy volume cluster. And ideally, if it's also a beginning of the fair value gap, and you'd be surprised, but very often it is, it aligns the beginning of the heavy volume zone and the start of the fair value gap. So in this case, this would be the short level, and if the price hits that level, then it is short from there. So again, you need to see a rejection, you wait for pullback to the heavy volume zone, and from the beginning of the heavy volume zone, you go short. Alright? This is how I trade rejections. Let's take a look at another example. In here, this is a bullish scenario. We have this rejection, and again, the first thing is we need to check whether this is actually a good rejection or if it is a trap. Alright, so let's go through the checklist again. First thing, is the market rotating? Look at this. Up and down, up and down, up and down. Yes, the market is rotating. Is the rejection strong? Yeah, this is beautiful low. This is a strong low. Let me delete that so you can see it better, right? Strong low. So, all good so far. Are the volumes distributed well? We have clear volume cluster in here. Below that, low volume zone. So yeah, volumes are distributed well. Is there a fair value gap? Well, in this case, I would prefer the fair value gap to be somewhere in here, right above this heavy volume zone. We do have fair value gap, but it is a little bit higher. Let me mark that for you. This bullish fair value gap beginning in here, but I prefer if it actually was beginning in here at the beginning of the volume cluster. In this case, it's not so clear cut, but if we go through the checklist, then market is rotating, rejection is strong, volumes are distributed well, but the fair value gap is above the place where I would like to trade. It's not above the heavy volume zone, so in this case, I would look at it like this. Because the fair value gap is there, but it's a bit higher, right? So if I wanted to be strict, the checklist would look like this, but still 3 conditions are met, which means this is a still good trade to take, right? So how to trade this? Mark the beginning of the heavy volume zone, and you can use a limit order there. Just place the limit order, wait for the pullback, and when the price hits that level, hits your limit order, then go long from there. Now, I haven't mentioned stop loss and take profit yet, and in this case it's very, very simple. Let's start with the stop loss, which is, at least for me, always at the bottom of the rejection. Right here. This is the stop loss, because the price really shouldn't go past that point. If it does, then the low is breached and there's no telling where the price could go from there, right? So this is the stop loss. And regarding the take profit, you want to trade with at least risk reward ratio 1 or better, which means that in this case the take profit would be somewhere in here. But in my trading, I strive to have a bigger risk reward ratio than 1. So in the long run, I try to have around 1.5, which in this case would be somewhere in here. But what I do is I look at volume distribution and decide on the take profit placement based on the volumes. But you know, in this video, I just wanted to focus on the rejection. So if you guys want to learn more about the exact way how I place my take profits, you might, for example, read my volume profile book or search for other videos on YouTube where I talk specifically about take profit placement. But simply put, the rule of thumb is risk reward ratio needs to be at least 1. All right. So yeah, this is how I go about this. If you guys are interested in learning more about volume profile trading or order flow trading or VWAP trading, then head over to my website. It is at traderdale.com, and if you click this button, trading course and tools, then it will take you straight to a page where you can browse my trading education and custom-made indicators. There's the volume profile pack, the order flow pack, the VWAP pack, and the smart money pack. You can get them separately in here. By the way, there are videos which you can watch that'll show you everything that's included in those packs in detail. And if you guys want all of them together in a discounted bundle, then scroll down a bit and you can get them in here. Alright? Now, if you guys would prefer to trade with me and other prop firm traders every day in a live trading room, then click this button. FTA stands for Funded Trader Academy, and on this page you can watch this video where I'll show you everything that's included in the Funded Trader Academy. And if you find that interesting and if you'd like to learn more, then book a call and we'll walk you through this course in this one-on-one call, and then you can decide whether or not this is right for you. Alright, so that's about that. I hope you enjoyed the video, I hope you found it useful, and I'll be looking forward to seeing you next time. Until then, happy trading!